The current live stock price of Sofi Technologies trades at $17.975 per share on the Nasdaq, down about 0.80% during the session, with an intraday trading range spanning between a low of $17.83 and a high of $18.41 on volume crossing over 32 million shares. Beneath this routine daily fluctuation lies a much deeper shift in institutional accumulation that standard market commentary completely misses, pointing toward a structural re-rating that few retail participants have factored into their models. Most market participants look at SoFi stocks and assume it is merely another digital bank fighting for consumer deposits in an overcrowded fintech landscape, often grouping it alongside standard online investing portals or basic individual brokerage accounts. The general consensus assumes that rising customer acquisition costs and credit provisioning will eventually erode margins, capping upside potential for SoFi investing enthusiasts who utilize various investing sites and mobile applications to manage their personal finances. Yet reality tells a starkly different story when you examine the underlying economics of their technology platform segment and corporate lending infrastructure. Rather than acting as a traditional lender dependent entirely on net interest margins, the enterprise operates as a dual engine, where software-as-a-service infrastructure licensing provides high-margin recurring revenue that completely decouples growth from credit cycle volatility. When users compare this platform to legacy financial giants or traditional platforms like Fidelity Investments, Fidelity ETFs, Fidelity Mutual Funds, Fidelity Brokerage, Fidelity Wealth Management, Fidelity IRAs, Fidelity Mobile App, and the Fidelity Trading Platform, they often miss how software integration changes the valuation framework entirely. Furthermore, when tech-forward participants evaluate trading alternatives such as Robinhood Stock Trading, the Robinhood app, Robinhood Investments, Robinhood Crypto, Robinhood Cash Management, and Robinhood Fractional Shares, they overlook how a comprehensive banking charter enables an entirely different class of asset retention and monetization. Similarly, sophisticated traders utilizing Interactive Brokers Trading, the Interactive Brokers Platform, Interactive Brokers Fees, Interactive Brokers Account, and Interactive Brokers Stock Trading recognize that regulatory moats dictate long-term survival in digital finance. Meanwhile, everyday savers exploring Schwab Intelligent Portfolios or setting up an intelligent portfolio often fail to notice how automated wealth building mirrors the sticky deposits that SoFi Robo-Advisor and SoFi Active Investing capture daily. People frequently lump online investment and online investing options into one monolithic bucket, but the structural separation between asset-heavy balance sheets and asset-light technology providers is where true alpha is generated. When looking at broader market comparisons, heavyweights like Apple stock, Nvidia stock, and even Tesla stock command massive valuation multiples because of ecosystem lock-in, yet the financial services sector rarely rewards software stickiness with the same enthusiasm. This disconnect creates a massive tension between public expectation and private balance sheet reality, setting the stage for significant upward repricing as institutional algorithms begin recognizing the fee-based revenue contribution from the enterprise software division. Daily swings in valuation often reflect macro fears regarding consumer credit health, yet actual delinquency rates across personal loans and student debt refinancing cohorts continue to perform better than Wall Street initial estimates predicted. Institutional desks have quietly stepped up their block purchases during periods of market weakness, absorbing retail capitulation and accumulating shares away from weak hands who panic at every minor Federal Reserve commentary headline. Trading volumes surge during major macro data releases, proving that algorithmic models actively re-weight the equity whenever lending yields fluctuate, yet they consistently underestimate the speed at which deposit growth scales net interest income without requiring expensive physical branch networks. Comment below how many shares of SoFi stocks you currently hold in your portfolio. Looking back at the historical evolution of the business, the company started out with a focused mission centered on refinancing student loans for high-earning professionals, gradually expanding its footprint into a one-stop digital financial super app. Securing a national bank charter proved to be a watershed moment, allowing the institution to fund loans using low-cost insured consumer deposits rather than relying exclusively on expensive warehouse lines of credit or third-party capital markets. This strategic transition transformed the unit economics overnight, expanding profit margins and providing a steady cushion against broader macroeconomic shocks that typically buffet standalone fintech startups without regulatory backing. Critics frequently point to past quarters of net losses as proof that the business model lacks long-term viability, ignoring the deliberate upfront investments poured into brand awareness, customer acquisition, and proprietary technology infrastructure development. Those historical losses were not signs of operational failure, but rather calculated customer acquisition costs designed to capture high-earning lifetime value clients early in their financial life cycles when they purchase mortgages, personal loans, and investment accounts under a single digital roof. Looking toward the future outlook, several major catalysts could dramatically alter the valuation trajectory over the coming quarters, starting with potential regulatory tailwinds and further adoption of their enterprise technology stack by traditional banking partners globally. As more legacy institutions realize they cannot build competitive digital interfaces internally without spending billions of dollars, outsourcing core infrastructure to proven software providers becomes an attractive financial necessity rather than a mere experiment. This B2B software segment carries phenomenal operating leverage, meaning that incremental revenue drops straight to the bottom line with minimal marginal cost, which will fundamentally shift the consolidated gross margin profile over the long term. Naturally, risks remain prominent, including potential macroeconomic deterioration that could spike consumer defaults, heightened regulatory scrutiny over digital lending practices, and fierce competition from both incumbent megabanks and nimble digital-first challengers. If unemployment figures tick upward unexpectedly, credit loss provisions will inevitably rise, testing the resilience of underwriting models under stressed economic scenarios and potentially triggering short-term earnings volatility that conservative investors dislike. However, if management continues executing on cross-selling initiatives and successfully expands their fee-based enterprise partnerships, the actual financial performance will easily eclipse conservative analyst projections currently baked into the share price. The tension between public skepticism regarding fintech credit risk and the reality of robust deposit generation and software scaling forms the core investment thesis for anyone analyzing this equity today. Ultimately, the market continues to price the enterprise as a cyclical lender vulnerable to economic downturns, whereas its actual trajectory resembles a high-margin technology ecosystem deeply embedded in modern consumer financial habits. As earnings reports roll in over subsequent quarters, the persistent gap between superficial expectations and underlying fundamental reality will close, rewarding patient investors who look past short-term noise and focus on scalable digital transformation.